Johannesburg. After the massive sell-off in global stock markets last month, the knee-jerk action caused by President Donald Trump's announcement on the last day of the month that the tariff tiff between Washington and Beijing was being sorted out limited the damages to some extent. Was that a dead cat bounce, or have we seen the end of the rout in global stocks? Time to scale up risk. No man's land is defined by the Cambridge English Dictionary as an area or strip of land that no one owns or controls. That is exactly where the global equity market finds itself. It is currently not controlled by the bulls, those who view the current market conditions as an opportunity to add to their equity holdings, or the bears, those who are negative on stocks and see further significant downside. For some time now I've advocated a fade-risk strategy which comprised the addition of gold to emerging market portfolios and the overweighting of consumer staple stocks in global equity portfolios. The global stock market's movements over the past few weeks have changed the picture dramatically. My proprietary market risk indicator jumped from -4% at the end of September to 10% at the end of October. Over the past 19 years, a break above 0%, neutral, to 15% indicated a minor correction in a bull market and therefore a buying opportunity, scaling up risk. Levels above 15% indicated a major correction and even the beginning of a bear market. At this stage it seems we haven't still are experiencing a minor correction in a bull market, and, yes, it may be time to scale up risk by reducing gold holdings in favor of emerging market equities and reducing exposure to consumer staple stocks in favor of growth stocks. But what do the underlying fundamentals say? The stock markets are offering value again. By my calculations, the rating of the U.S. equity market as measured by the Shiller-P ratio of the S. That same day, the rating of developed market equities as measured by the Shiller-P ratio of the MSCI World Dollar Index was 22.5 points, a discount of 8% to what it should be given the latest G7 Business Confidence Index level. A recession in the U.S. is not in sight yet. The U.S. yield curve as measured by the gap between the 10-year and 2-year government bond yields has not yet signaled a peak in employment in the U.S. The U.S. still has ample spare capacity, with capacity utilization currently at 78% compared to the highs and pre-recession peaks of 83% in 2000-2006. Trump has already gone softer on his stance on tariffs with America's neighbors and some other countries. He conceded a lot on the sanctions on Iran. Most importantly, major economies such as Japan, China, India and South Korea will be allowed to import Iranian oil. The current scale of the stimulus measures and possible market intervention by China is such that it could add spark to the global economy, as it did in 2008-2009 when it pulled the global economy out of the slump caused by the global liquidity crisis. Technically speaking, global equity markets are nearly as oversold as they were near the bottom of the markets in October 2015. In my opinion, there is a more than even chance that a post-midterm election rally will happen and that the year will end on a higher note. It is also possible that the highs in developed market equities may be tested again. It is also likely that the rout in commodity prices such as copper and commodity-related equity markets and emerging market assets and commodity-related currencies may come to an end. Big-ticket stocks such as Amazon and Apple, down 20% and 13% from their recent highs respectively, may regain their glitter. I do see it as a high-risk rally, though as the so-called elephant in the room, Trump is capable of disrupting markets and economies at any time through statements and efforts to increase protectionism. The outlook for next year is also highly uncertain as the markets are likely to continue to lose momentum. RYK de Klerk is an independent analyst. Contact him at email protected. His views expressed above are his own. You should consult your broker and/or investment advisor for advice.